Now let's get the big picture. Ed Siddell is standing by, Chief Investment Officer and CEO, EGSI Financial. Great to see you, Ed. Hope you're doing well. Wanted to see how you are feeling about the market and the economy.
Well, thanks for having me back, Nicole. The market's it's resilient. It's still looking and expecting the Feds to lower rates. I think inflation is going to be around for a long time. But the economy, it's not just slowing. I mean, we're seeing, based on jobs numbers, home sales, it's really, there's a contraction going on. But, the big picture for us is, as far as our clients and investing, we're really being very, very cautious. We've got some money sitting on the sidelines, and it's just a wait and see. Having said that, there's going to be some opportunities, and we're just really kind of biding our time to find those opportunities.
I want to hear more. So you think that the economy is in contraction, and you're using home sales and labor as sort of an indicator. What? Tell me some more things, specifics that you're watching.
Yeah, so when we look at the jobs numbers, last year we saw the jobs numbers being revised down, month after month. And then this year they revised them down for all of last year. We're also seeing the number of open positions also shrinking. We're seeing significant layoffs, across the spectrum, from blue collar jobs all the way up to professional jobs. One of the things that we're also seeing, from a home perspective, you've got different regions of the country, from Florida down around Cape Coral, Fort Myers, Arizona, Austin, where there were very few homes. Inventory was really shallow, very short. And now we're seeing a large inventory. Prices are starting to come down. And so even with rates being lower, the inventory that we're seeing in certain areas is a little bit higher than it was just a year ago. And so that's telling us that things are starting to slow down, all the way across the board.
Understood. Where do you think, the Fed is headed? Are we hearing one cut? Is that sort of what you're thinking? Is that the right move?
Yeah, Nicole, honestly, we believe that they should not cut rates. They actually need to raise rates. As soon as they cut them, inflation is going to come roaring back, but they really don't have a choice. I mean, they've kind of painted themselves in this corner. The Fed's created the situation that we're in right now with all the quantitative easing, lowering rates as low as they did, and now everyone's kind of shocked when all these loans are coming due and the rates are significantly higher. And so the last thing that the Feds can do, if they raise rates, everyone keeps talking about a hard landing. It's going to be a extremely hard landing if they raise rates. So the only thing that they can really do is lower rates to have that soft landing that they've been talking about. But it's going to be short-lived. As soon as they do that, what's going to happen is inflation is going to come back. So I think really, because it's a political football right now, that's what they're looking at. You hate to say it, but that's kind of a reality. And we just continue to kick that can down the road. But eventually we're going to have to face it.
Right. So, when you started that sentence, you were talking that the Fed should not cut rates. In fact, they need to raise rates, but they really shouldn't do that either, because you had concerns about that. So right. The Fed should probably just stand pat, is what you're saying. Till when? Till the new year?
Till after the election going into 2025. I mean, if they raise rates, it's going to be turmoil. Right. I mean, already the service on the debt is the second largest line item behind Social Security. It's going to create a strain on the banking system, all the way across the board. If they raise rates. If they lower rates, inflation is going to come roaring back. So really, holding steadfast is really the only option that they should be doing right now. But they're probably going to lower rates. Probably only one time is all I see. September, maybe out in November. But that's all I see for right now. It could change, but that's all we're seeing.
Right. So at this point now, for someone's portfolio, how should they plan the portfolio? What kind of things should be in the portfolio?
It should be really broad and diverse. I mean, everything is based on someone's risk. Like for us, it depends on where they're at in their economic life cycle. How much risk can they afford to take? And if they already have cash on hand, why not just do very safe short-term treasuries, where you're getting 4.5% or more with absolutely no risk, and wait till we see what shakes out and then disperse that cash a little bit later on, or unless we find some really good buys. There are some things out there that I like. I still really like Lowe's. I like industrials. But again, we're very, very cautious with redeploying capital at this point.
Right, understood. What about abroad? Do you look abroad sometimes when you're investing? And if so, what do you do there?
You know what? We do. I still like certain parts of Asia, Europe, not so much. I mean, when we look at the broader economic picture globally, we're seeing struggles all around the globe, just like we're seeing here. We saw the ECB lower rates. We saw Canada lower rates. A lot of central banks are already doing the lowering rates and already starting down the easing path as well. So, again, there are certain areas like India that I do like, but for the most part, we're just being very, very cautious.
Yeah, I think Bank of England is coming up too. Ed Siddell, thank you, EGSI Financial. Great to see you. Thanks.